right. Hello, everybody. Welcome to the SJ podcast. Justin Halverson here. I am joined today by Nate Jefferson, Matthew Mancini, and Andrew Long. And we are going to talk about the speculative bubble that a lot of people are talking about that's going on in the stock market right now. So before we do that, we're going to touch on everybody's stories. Nate, looks like you wrote about the K-shaped recovery this week. Can you kick us off, please?
Thank you, Justin. Yeah, income inequality has been a big problem within the United States, and it looks like that problem is continuing to grow after COVID happened. With that, there's been this new economic outlook from looking at the recession and going out of it, called the K-shaped recovery. And I just go into depth on what that is and what that could potentially mean for some of the Americans within our country.
Yeah, great article, Nate. That's a term I know I never heard in any of my econ classes that we started hearing like a year ago, and it's just more and more popular. So I'm very glad that you touched on that. Matt, it looks like you were talking this week about something we've all heard about, this boat stuck in the canal over there. Can you tell us about that?
Yeah, so there was a boat, the Ever Given, that was stuck in the Suez Canal. It actually just got freed this morning, but before there was a lot of trade that was disrupted. About 12% of all international trade goes through that canal. And there was also a lot of memes that were created. So if you want to learn more about that, go and check out my article.
Yeah, I have definitely seen a lot of those great memes. So we've got another great guest on the show today, Andrew Long, the Spartan Journal producers. So Andrew, I forgive me, I didn't ask what you're writing about. So can you just tell us, man, what did you write about this week?
Yeah, all good, Justin. I'm really glad to kind of step back in as writing an editorial. And if you guys hear any background music, like background noise, I'm currently in a Big B because my Wi-Fi shut down, but I wasn't going to stop me from coming in today. But this week I wrote about negotiations, and I recently watched a video of Harvard negotiations professor Deepak Malhotra talking about his 22 tips to improve negotiations overall. I put in some of my favorites from that conversation and just gave an overview of how to execute negotiations in a really efficient manner. So I hope everyone gets the chance to check that out. Really excited for today's discussion.
Awesome. I'm excited for that article too, Andrew. Yeah, the negotiation skills, it's something we can all definitely use in the business world. So yeah, to kick off the discussion, I'm just going to pass it back to you, Andrew, and just leave it with this brief opening. Are we in a bubble, man? We hear that word quite a bit. So what do you think, Andrew? Can you kick us off? Stock market, is it overvalued? What do you think?
Well, absolutely. Well, I think it's overvalued. We've been in a really bullish trend for a while now. And, people are questioning whether or not the price of a lot of stocks and the S&P is exceeding its fundamental value. And there's a lot of different things that kind of lead to that. And recently, a lot of holders were selling off a lot of their tech stocks positions, if you guys are familiar with that. And it's starting to see that trend of how everything is starting to dip post-pandemic. Were you guys familiar with a lot of the tech drop-off?
Yeah, I do. I've actually got a chart here. It's like the price to sales of the current tech stocks. But yeah, it's not been doing so well. Sorry, Matt, go ahead.
Yeah, no, I saw it too. I definitely think that I actually thought that there was a bubble that was being formed even before the pandemic hit. There were, stocks were on average every 5 to 10 years. There is a huge, like boom, and then there's that contraction, there's that bust. And I think that even before the COVID pandemic hit, once it hit, I was like, oh, like here's the crash, here's whatever. And then stocks just go right back up again. And I think that doesn't really reflect like the whole business cycle. Like every, couple of years, there's always that business cycle. And before the pandemic, we were actually in our longest bull market in history, like ever. So I think that kind of is like a big indicator, like, something might be messed up.
Yeah. And And that was really one of my questions was, when it crashed during the pandemic, what were the drivers for what we're currently seeing now? And I was thinking about, like, we were calling it the speculative bubble, speculative demand by a mass population coming into the market, a lot of them first time investors, and sort of that behavioral investing and if you guys haven't seen it, Justin wrote an article on behavioral investing and cognitive dissonance. And how much do you guys think that sort of cognitive dissonance or behavioral investing has provided to within the past year since the pandemic started? Because I think it has a huge um, influence on what we're currently seeing now.
Yeah, I think it played a huge role in what we're seeing right now, in terms of the financial literacy and the lack thereof of people getting into the stock market and not really understand what they're putting themselves in for. And I feel like it was more of people trying to find the biggest returns possible rather than investing in things that they loved or understanding what could potentially be dangerous with some of the stuff they're investing in. And that's why we see, a high valuation for a lot of these small cap companies and a lot of these IPOs, just from that standpoint of people seeing that, hey, I can get the best return from a new IPO in my mind rather than a blue chip stock, a stock that's been around for 20 years. And so they're putting all their money into that and trying to see it explode, where in reality, it might not be the best situation. And you also talked about, a lot of these speculative assets. I've seen so many new speculative assets than I've ever seen before, just from the standpoint of people really want to make money and they're in an industry where you're able to make money. But if you're not properly educated on how to do it, you can end up losing a lot of it. And I feel like that's what we're seeing right now.
And kind of building off that too, Nate, we were talking about like new assets and stuff like that, the rise in SPACs and people taking private companies, tossing them in there and trying to get returns I think it's mainly because of the environment surrounding the market, and they're trying to capitalize on those moments. Justin, did you have any sort of insight based on like your article, what you wrote on sort of the populace and the population kind of going into the market?
In terms of like in the bubble perspective, I guess if I'm understanding your question correctly, I don't know, what we're seeing is there's super low interest rates. I guess when I say that, combined
Mm,
with a combination of a lot of people who are sitting at home during the pandemic, you're right. And that, for like you say, like a lot of people got into the market for the first time, and everybody knows buy low, sell high, right? So I think that like talk about investor behavioral psychology. I think there was a lot of that going on, like the FOMO. I wrote an article, yeah, about FOMO investing too. Like people, when you see your neighbor next door getting rich and you're not, like that's a much more powerful driver for human emotion than it is like, oh, the S&P returned 10% this year, like any kind of statistic that you can throw at somebody. So I think it's a combination of people have more access, and then it's just a lot more in people's faces, like you're seeing it on your screen, you're seeing it. I know we put out a lot of content, we're obviously doing that on purpose. We try to put out good educational content, but unfortunately, there are people who don't do that. So I think it's FOMO, if that kind of answers your question.
Well, a lot of it's also, like you said, behavioral investing. I mean, if you look at back then during the tech bubble, it was taxi drivers investing in these stocks. Now it's a bunch of people on Reddit. And there's actually a book that I read, This Time Is Different. And it basically talked about how these people, there's just this irrational exuberance. There's people that are like constantly thinking, oh, it's going to go up, it's never going to go down. And you see the same thing with Bitcoin nowadays. You see the same thing with Tesla, where it just constantly goes up, and it has to hit its peak sometime. I mean, it can't be like Berkshire Hathaway, where it just, it's a $300,000 stock. I don't see any of these becoming that. I see that it's gonna hit a peak, and that's the negative. Partially, that's the negative with the Bitcoin. It's gonna hit that peak, but it's so volatile that you don't know when that's gonna hit.
I've got an interesting chart I want to show you guys here. This is the surge of IPOs since 1981. Companies that went public. So for anybody, a little bit of background too. Before, like Matt said, in this bull market, there's actually a lot of talk that there is a problem with companies going public. You can see that area from maybe 2008 to 20. It doesn't, the trend is pretty high, but there are a lot of people talking that we don't have enough companies going public, and there's a lot of companies that are staying in the private equity space. Well, we can see that that's changed with IPOs, with SPACs, with all this money, sloshing around in the market, so to speak. Like, people are looking for places to park their cash. So I thought this was a pretty interesting chart, because you can see, like, we are at record highs. Like, the amount of companies that are going public, it's never been seen before. So
Yeah, it just goes to show the market is hot. And I feel like that can also be things based on the amount of ignorance that's in the market, just from the standpoint of, again, there are a lot of people within the market that really don't know what they're doing, but yet they're trying to make a lot of money. And some of them might be trying to make money based off the whims that were working previously, like the technology sector, right? Like, the technology sector was a previously extremely very lucrative sector. But we're starting to see a shift from that, just from the standpoint of everybody putting their money into the technology sector and making the price overvalued to where that the price needs to come back and be corrected some way, somehow. And people aren't understanding that because they don't understand some of the fundamentals when investing into a stock or an ETF or that replicates a specific industry, right? And so when we get into these conversations and topics, we really have to talk about financial literacy and just the concept that people really don't understand what they're getting themselves into. And as a result, we're seeing an overinflated price for many of these stocks, many of these industries, because people are just throwing money at it like it won't ever go away.
Yeah, and it also kind of speaks to like what Justin was saying about buy low, sell high. Even I know a lot of people, friends of friends, maybe people that I like, a lot people that I'm not directly connected with, that followed the herd mentality, short-term thinking, that with the expectation that they can beat the market, or if they're unfamiliar with the market, and it's just really simple. It's very difficult to beat the market just because of the high volatility and sort of the direction of where the market is right now. And also, it's in talking regards to bubbles. Uh, if we take a look at some of the major bubbles in the past, like Matt was saying, the dot-com bubble and the 2008 mortgage crisis, are we seeing any similarities there? Because I think this is more of we're talking about a stock market bubble primarily focused, because there are multiple different categories of bubbles. It could be a particular industry, it could be a credit bubble, but what we're seeing is primarily a stock bubble. Is that correct, Matt?
I would say that it's definitely like, because even, you said 2008, that was the housing market bubble. The 2019-29, that was all stock market. So it really just depends on like what you define as like a bubble. Because if people usually just think, oh, it's the stock market. Once the stock market goes down, that's the end of the bubble. But no, like, bubbles can be anything that's a financial asset. And let's look at Bitcoin. Let's look at cryptocurrency. What's happening with those? They gained 100% since the beginning of this year. This year, within the past 5 years, I think it's gained like 2,000%. That's unheard of. That's if we saw housing, it's tulip mania. It's tulip mania. It's crazy. And a lot of these people, they're looking at it like, it's the future, whatever, but like, who cares? It just, no asset should go up by that much. It's just, it doesn't make logical sense.
And kind of referring it back to like the dot-com bubble, I was doing research prior to this podcast. The combined value of all the tech stocks back during the dot-com bubble was higher than the GDP of most nations. Just think about that in perspective. And we could even, in like comparing, Bitcoin and cryptocurrency might be the future, but is it really worth the value that it's currently at right now? Difficult to say, but it's just a kind of interesting comparison that we're seeing, like the things that happened in the past, and then this is what we're currently living through. Does anybody else have any follow-ups with that?
And go ahead, Nate. I've got a chart to show, but go ahead. I'll go after you.
I was just about to hop off a point you made previously, and just, again, the accessibility of money, cheap money at that. Like, we're not just seeing inflated prices within the stock market. We're also seeing it in the housing market, right? There's a large amount of houses that, or they're on the market. I'm sorry, there's a large amount of people that are ready to buy houses because of the access to money, but not many houses because everybody has the money, but there's only a limited supply of houses and they're buying them up like crazy. And because of that, the price of housing is going up. right? Like we're seeing so many homes that
With
are becoming
premiums.
exactly more and more expensive, to where it's like, okay, maybe I really don't want to move. And people are starting to reassess whether or not they want to find a new home, and or they want to just remodel the one that they're living in, you know? So, I mean, that's another bubble we could talk about, the home values and home prices that are shown to be inflated at the moment.
That's an interesting one. Before we move on to that whole can of worms, because I think that has a lot to do with interest rates. That's my personal opinion, but like you're saying, access to cheap money. Relating it to like the tech bubble, I guess, of the late 90s, looking at price to sales of different tech companies. I was reading this article this morning. The typical stock, if it's trading above 15 times price to sales, doesn't do well historically. It's like 70% of these companies over a 20-year period tend to go to zero. So that's not very good. This chart right here is showing you price to sales of all these different tech companies since the late 1990s. So a trend with a lot of these tech companies like Amazon, Google, Facebook is they trade above that 15 price to sales. They actually pop right away. They go to like 20, 25, but then over time they settle down to 10, 12, 15, get something lower. If you're seeing some of these tech stocks currently, so Zoom, that's the one that sticks out in my mind. Like Zoom is trading above 100 times price to sales right now. And a lot of people, we're in a different economy. That like, I'm going to link to this in the show notes. This is a Michael Batnick article. And like, he goes on to explain why we're in a different economy and it's not the same, but seeing something like this to me is kind of alarming. It's like, wow, this is never before seen.
That's
Well, same with
really
Tesla too.
interesting.
Tesla was like, they were at like 1,000 or like 1,200 one time, like right before their stock split. I was like, seriously? Like, and I actually just saw an article too where I think they're valued like 10 times more than GM, the biggest car company in the world. Like, that just doesn't make sense to me.
And you know, General Motors, the fundamental history and progression, and that it kind of comes with that. But boom, Tesla's in, and the difference is completely radical. So that's and going back to what you were saying, Nate, and kind of giving the listeners and all of our Spartan Journal readers a little bit background that historically, the more involved that credit is leveraged in sort of these bubble situations, the more damaging the recession comes when the bubble finally pops. So, and I was looking at a research study called Leverage Bubbles, a 2015 research study, and it kind of relates back to the mortgage crisis of 2008. And this kind of makes me want to wonder right now, currently, because we're talking about asset bubbles and we're talking about stock bubbles as well. Is that Nate was bringing up the current premiums on real estate currently right now. Are you guys seeing any other markets or any other parts of the industry, maybe with the tech or the electric vehicles, that are overinflated, or do you guys think that it's pretty consistent across the entire market?
I don't know. I'm not going to
It's a
say
big question.
It
you
is.
know.
It
I guess
is a
to
big
answer that question, what I'm going to say is I think we're seeing a sector rotation. That's what I think we're seeing. Now, small caps got hit hard, but if you look small caps get hit hard this last month. I think they're technically in correction territory. They were down 10%. But if you want to look at actually the year-to-date performances, I believe the Russell 2000 outperformed the NASDAQ 2020. Like, I think we are seeing a sector rotations. So I don't know if you're seeing other parts valued. So that's actually, I'm kind of, it's interesting. We're talking about a bubble here and there. I think that there's certain companies that are very overvalued, but I also want to throw out this. I don't know if this is exactly a bubble, because of something like you brought up, Nate, in your article about the K-shaped recovery. We have a full economic reopening in front of us, guys, which is pretty incredible here. Like, I do, like I'm showing you these things, and I do think you're looking at some of these like price to sales ratios. Like, this is absurd. Like, I could obviously say that, but we have a whole year of reopening ahead of us. And we have another round. Like, I believe Biden's going to be speaking today or tomorrow about his new infrastructure plan. Like, that's even more money in the markets. So I can't remember what the 5 stages or 4 stages of a market is, or a bull market, but the last one is euphoria. And what I remember about that statement is the 4th stage of a bull market always lasts longer than what people think. So I have no idea what's going to happen. I don't have a crystal ball, but wanted to throw those things out there as well.
That's a great point, Justin, because when we were previously talking talking about the tech sell-off. The reason a lot of the people were capitalizing on their tech positions was because of the economic recovery. They believed that the economy was going to do a lot better, considering, you know, the stimulus packages that Biden was pushing through, the vaccine availability, and the economic reopening.
Well, yeah, and you are right about like the euphoria, because I think it was like, sorry, I'm kind of a history buff, but in like 1996, when Alan Greenspan gave his speech about the irrational exuberance, it wasn't until 2000 when there actually was the burst in the bubble, or like the dotcom, you know, era. And I think that definitely like kind of might show nowadays is like I said earlier, you know, it might go up, it might continue to go up, but it's so volatile that you just don't know when it's going to go down.
Couldn't that just mean that it would become even more overvalued at that point if we believe that it could potentially be overvalued at this point in time? And if more money goes into the stock market off the basis and belief that, hey, we'll see an even better economic outlook than we will now, but people really aren't really sure what they're investing into, couldn't that just mean more trouble when it comes time for that correction?
Oh, I definitely think so. I definitely think that if it continues to just like go up and up and up, that it might be even worse. And I think it's just all based on speculation. People don't know. Like that's the biggest like disadvantage of being in finance is that risk aspect. You don't know what the future is going to hold. Like you just don't know.
Yeah, and I think you were the one that hit on it, that talked about how long we were in our previous bull run before the corona recession hit. And for me, like I'm used to recessions based on my like 19 years of life hitting a little bit harder than the few, what was like 3-4 months that the corona recession hit for. And so like at the same time too, like I want to be optimistic on the outlook of looking at another bull market, but then at the same time, it's just like we really haven't felt the effects of a real bear market. And at the same time too, we really haven't seen the amount of support from the government in terms of printing money and making sure that everybody's taken care of that we've seen this previous year than we've ever seen before. Like they've been really on top of it when it comes to being of aid. And I feel like that is a substantial factor when it comes to allowing the market to go back up. But then at the same time, it's just like the amount of speculation that's going into the market in this current time, and then understanding where we could be in the future from the standpoint of vaccine rollouts, the economy opening up, industries being able to do business again that weren't able to previously. It's just like, oh my gosh, like maybe it's like a whole wave of speculation that we haven't even seen yet. So I'm interested to hear what you guys think about that.
Well, yeah, I mean, also there's you mentioned it, how there was like the recession only lasted 3 to 4 months. That was like the stock market's a leading indicator, which means that when the stock market crashes, that's when, you know, the economy's, you know, going down. But the lagging indicator is like the housing market, the consumer like spending products. And I think that unemployment. Yeah. Those are lagging indicators. And that's what we saw kind of afterwards. So I think this recession has lasted a lot longer. Although the stock market went up, it's lasted a lot longer than we might think it has. I think it's lasted all of 2020 and 2021 because, I mean, unemployment's still down. So
I agree. Yeah, Matt.
No, that makes sense. So in terms of a recession, do you think the 1-year recession, like I shouldn't say good enough, but do you think that's effective to take care of all the not disparities, but the problems we've been seeing within the stock market in terms of valuations?
So I guess here's the other, so I keep alluding to interest rates. So something that I personally believe that has to be brought up is like the Federal Reserve is committed to doing 2 big things until 2023, and that's keeping interest rates low. And that's also doing a federal bond buying back program. So that means they're constantly every single month, guaranteeing that they're going to buy back treasuries, which ultimately keeps the price of government bonds lower than they would if they weren't doing that. So that being said, investors, or an investor community, you want a well-diversified portfolio, but you also need to earn a return over time. So when the real return on bonds is literally zero and sometimes negative, as an investor, why would I park my money there, right? So I think that also fuels a lot of this speculative activity. So like to answer your question, Nate, I know that was kind of a roundabout way, like until that kind of activity stops, in my opinion, I don't see how this speculative bubble, so to speak, because people have like, it's going to end because people have money in their pockets. They need to earn a real return, and they're seeing that fixed income is not an option. So like alternatives, if you guys are familiar, that's a whole nother can of worms, but the alternatives bucket, that's just becoming more and more popular in the financial planning space because of the fixed income, like what's going on with fixed income right now. So hope that wasn't too technical, but I think that has a lot to do with it as well.
No, I completely agree with you. I think that, like we talked about earlier, is there like, is everything super over speculative? Like, and I don't think that's what the same thing with bonds. I think that bonds they kind of are just a flat line throughout the whole time, and I think that definitely plays a part in whether or not we're going through this.
Kind of also hitting back on what we were talking about in terms of like we're talking about a speculative bubble, looking at the stock market, and there's no avoiding that, because at the end of the day, I feel like, especially going into where we are now, I like to reference it as the fourth industrial revolution. We're within the next 5 years, we're going to hit 10 years of technological advancements and broadband communication and technological advancements. As that increases, people are going to be able to connect more. And I also feel like there's too many people, there's too many influencers to not change sort of the spikes and falls and the volatility that we're going to see in the stock market. Talking specifically to the stock market, we've been talking a lot of macro economic factors and what we're seeing, but bubbles like this with the stock market, or bubbles, quote unquote bubbles, that we're seeing are always going to be relevant. There's depending on, but we always need to, as investors, focus on fundamental value.
Absolutely, absolutely. And I think with the amount of money that's been put into Americans' pockets due to unemployment money, whether they need it or not, I know a few people that definitely didn't need it and they got that, but they were able to invest from that, and that's awesome. Also, stimulus checks, whatever it may be. I mean, that helps too. And understanding with that money, they'll look to make some way, somehow happen that they grow that money. Most people go to the stock market to make that happen. And if they're going just off the basis of they're going to make money and not really off the standpoint that they need to educate themselves, then we can see an inflated price in certain industries, certain specific items when it comes to investing. And I feel like that could be a problem. And also touching on the topic of a lot of readily available money is in the hands of brand new investors for a very, very low price. And so when it goes to the future outlook of what investing may look like, I hope it doesn't look like this. And I know it potentially won't look like this, just from the standpoint of rates will change, markets will correct, people will lose a lot of money, but at the end of the day, it's all learning lessons. So yeah.
Well said, Nate. You said markets will correct. For young people like us, that just means stocks are on sale. You truly, that's said on Reddit all the time, but it is true. You haven't lost money until you sell. That is the truth. If the market dips like it did last March and you buy a bunch of stocks, hold on to those for a year and look what happens. So us as young people with a really long time horizon, we shouldn't be afraid of bear markets. We should actually be happy and rejoice for them, because that means it's a fire sale.
If you enjoyed the discussion, please like and share the podcast on Apple and Spotify. The Spartan Journal podcast is part of Michigan State University's Wealth Management Association, a student organization whose goal is to inspire the next generation of financial advisors. The Spartan Journal news team releases a newsletter every Monday morning comprised of financial literacy and the week's market updates. Feel free to follow us on social media at msuwma and check out our website at msuwma.com.
Anything heard on the MSU WMA podcast is for educational purposes only and should not be considered as investment advice.